What if the Treasury's 261 million ounces of gold that they say they have isn't really there? What if they're scrambling? What if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That caused the stock market to tumble, and that will bring down the whole house of cards.
You're watching Silver News Daily. Subscribe for more.
What if I told you that the gold at Fort Knox, the very foundation of the US dollar's credibility, might not be there at all? Imagine waking up to the news that America's most guarded treasure has vanished. The ripple effects would be catastrophic. An inflation tsunami, a debt doomsday, and a global financial meltdown all triggered in an instant. Michael Pento believes this shocking revelation could send precious metals, especially silver, into a historic surge. But here's the catch. If you don't act now, you might lose everything. Think about it. How would markets react if the ultimate backstop to the world's reserve currency simply disappeared? Could this be the moment silver finally breaks free and skyrockets? Stay with me, because what you're about to hear could change how you see the future of your wealth forever.
Well, it's inflation and solvency, as always. So you look at supply and demand of treasuries, which are it's a tsunami of treasury issuance that's going to happen, regardless of what Doge does. Because they have to tackle Social Security, Medicare, and Medicaid. They're not doing that. Defense, that's going to be a tough nut to crack, and interest on the debt. So you're going to have $2 trillion deficits as far as the eye can see, and that's the good news, Dunnigan. What if we get a recession? Then the deficits go to $6 trillion automatically because the revenue shrinks and the stabilizers kick in. So you're going to go to $6 trillion. Who the heck's going to buy it all, Dunnigan? And at what price? The price is going to be much lower, and the yield's got to be a lot higher. So this is a tremendous supply issuance, and then you have to. So you look at the inflation dynamic along with the supply imbalance. Well, we have a very hard time getting inflation under control in this country. You know, Dunnigan, the Fed says that they have a 2% inflation target. Let me ask you a question. You're a smart guy. I think you're smarter than most people. I really do. Do you think that the Fed has reached that 2% target anytime in the recent past?
Not even close. I mean,
How long? How long has it been?
I don't think in most of our memories.
Or it has been 4 years, just 1 month now.
This is based on their numbers.
So they have missed their they have an average target of 2%. Could be below, could be above. 2.5 is good if 1.5 is also thrown in there, but it should be around 2%. The Fed has missed its inflation target to the north by almost 4 stinking years.
By their cookbooks.
By their hedonically and substitutionally massaged, manipulated mendacity that they use called the CPI. And even if you look at the PCE, that's not a 2% either.
Gold isn't just a shiny metal sitting in vaults. It's the silent pillar holding up the entire U.S. financial system. For decades, Fort Knox has symbolized the last line of defense for the U.S. dollar. Even though the dollar no longer operates on a gold standard, the belief that America holds the largest gold reserves in the world underpins global trust in its currency. But what if that belief was shattered? If the gold supposedly tucked away in Fort Knox were gone, the dollar's credibility would collapse overnight. Global markets would question everything, the value of the dollar would plunge, inflation would explode, and panic would ripple across financial systems worldwide. Think about it. If gold is the ultimate insurance policy for the dollar, what happens when that insurance is revealed to be worthless? The fallout would be immediate and brutal. Investors would dump dollars and rush into tangible assets. And while gold might be the obvious safe haven, silver would be the dark horse poised for a massive breakout. Silver, often overlooked, plays a unique role, not only as a precious metal, but also as an essential industrial resource. In a crisis where trust in paper money evaporates, silver wouldn't just follow gold's rise, it could outperform it. Michael Pento's warning is clear. The potential disappearance of Fort Knox's gold wouldn't just be a national scandal, it would be a global catastrophe. The dollar's dominance would erode, interest rates would spike as foreign investors fled U.S. debt, and inflation would spiral out of control. In this scenario, silver's dual role as both a monetary hedge and an industrial necessity could set the stage for a historic surge. But before we explore silver's potential rise, we need to dig deeper into a story that's been hidden for decades: the U.S. gold audit controversy that could hold the key to this entire crisis.
Reserves in the system are so there's the reverse repo facility, which is the excess reserves was parked at the Fed. That's gone. That went into the Treasury complex, and that went into the economy. So when you look at 2019, when we had a repo crisis, that's when the reserves went to around $2 trillion. And that caused the repo crisis. So that's when they printed, we went all the way up. Okay, so it was the repo crisis, then COVID happened right after that. We were headed for a recession anyway. They printed trillions, like I said, $5 trillion, and the reserves went up through the roof. I think they went to $5 trillion. Now they're back, now they're down to 3.3. My numbers might be slightly off, but they're not that, but you get the idea. So we know that the level of reserves can't go to $2 trillion, but what will Powell allow them to go down to? I don't know. But that's going to be a problem maybe a year or so from now, maybe two. I don't know. But before that problem happens, and it will happen, in my opinion, you're probably most likely to get a problem in the funding of the Treasury complex, which is going to cause a spike in long-term yields, which the Fed does not control directly. And that will be the catalyst for the next liquidity crisis.
For decades, the U.S. government has assured the public that Fort Knox's gold reserves are safe, secure, and fully accounted for. But what if those assurances are nothing more than smoke and mirrors? The truth behind America's gold audits is far murkier than most realize. The audits that were supposed to verify these reserves have been riddled with inconsistencies, missing records, and most alarmingly, broken tamper, evident seals. How can anyone trust that the gold is still there when the very process designed to prove its existence is so deeply flawed? Let's break it down. Since 1974, the U.S. Treasury claimed that 10% of the gold at Fort Knox would be audited annually. By 1983, all compartments were meant to be sealed and inspected each year thereafter. Yet, from 1987 to 1992, there were no audits at all. Then, when the Office of Inspector General took over in 1993, their reports failed to mention that vault compartments had been reopened multiple times. A clear breach of protocol. Why would anyone need to reopen vaults that were supposedly sealed forever? And what happened inside those vaults before the seals were reapplied? The story gets even more suspicious. Key audit and assay reports have been lost or destroyed. Entire sections of gold were excluded from verification without explanation. And while officials insist the gold is there, Freedom of Information Act requests have uncovered documents that tell a different story, one of secrecy, deception, and potential cover-ups. If Fort Knox's gold reserves are missing, or worse, never there to begin with, then the dollar's last backstop would be gone. The trust propping up the U.S. financial system would disintegrate overnight. And this is where silver enters the picture. Because when trust in gold reserves evaporates, and the dollar's dominance comes into question, investors don't just sit still. They move fast, rushing into alternative assets that can preserve value. Historically, silver doesn't just follow gold during crises, it surges past expectations. But before silver's explosive potential can be fully understood, there's another crucial element we need to explore: how missing gold could spark runaway inflation, and why silver could be the ultimate inflation hedge.
So here's what I think is going to happen. And let me say parenthetically that I am not yet short the market, but the market is so expensive now that even though it's not going to crash imminently, there's just not a lot of room for it to go higher. So if you look at things like the total market cap of equities to GDP, or the price to sales, the S&P 500, or the median PE ratio, the Cape-Shiller 20-year inflation-adjusted PE ratio. If you look at things like risk premiums, which are negative now, so you take the inverse of the PE ratio and you subtract something like a treasury from that metric, and you say, wait a second, I get paid more to just own T-bills than I do with the earnings yield on stocks. That's very, very rare, Dunnigan. So you buy stocks, you own a lot of short-term bonds, and you wait. And one of these two things is going to happen. Look, I don't know what the level of reserves in the system that causes a panic is going to be this time around. I know last time it was around $2 trillion. So, there's always more reserves that are needed in the system because they're backing all these assets, all this money that's been created. So I think one of these two things is going to happen. The reserves are going to tick down to a level that causes a repo crisis and a money market crisis. That's one. Or more likely, we're going to get a crisis in the long end of the bond market now that the RRP is down to basically empty. And you'll have a spike in long-term interest rates, which causes a problem in the stock market and in the economy in general. So those are the two things I'm looking at most assiduously. But until then, it's just like, hey, give me my 4.25% to 4.5% on T-bills. I'm going to be long a couple of key sectors like inflation hedges, like gold. And I'm going to wait. I'm going to wait for my model to signal when the money markets begin to freeze. The money markets always freeze first, and then the stock market will crater, and then the economy will tank. That's what I'm doing.
Inflation, an invisible force that quietly erodes your wealth, could turn into an uncontrollable tsunami if the Fort Knox gold reserves are proven to be missing. Think about it. The US dollar's global dominance relies heavily on trust. And a major part of that trust comes from the belief that Fort Knox holds the largest gold reserves in the world. If that belief is shattered, the dollar would instantly lose credibility. Global investors would dump US assets, the dollar would weaken, and prices would soar. In other words, inflation would run wild. But here's where it gets interesting. During times of inflation, investors scramble for hard assets. Gold is the traditional hedge, but silver? Silver is the secret weapon. Why? Because silver has always been the underdog with explosive potential. Historically, when inflation spikes and gold starts climbing, silver follows. But it doesn't just follow, it outpaces. In 1980, when inflation was running rampant, silver shot from under $6 to nearly $50 an ounce, outperforming gold in percentage gains. And in 2011, silver repeated the pattern, surging from $9 to almost $50, again leaving gold in the dust. But this time, the stage is set for an even bigger breakout. If Fort Knox's gold is missing, the inflationary shock would be unprecedented. The dollar's collapse would trigger a global flight to hard assets, and silver would stand out for one key reason: accessibility. While gold remains expensive and out of reach for many retail investors, silver is affordable and accessible. As panic sets in, silver could experience a demand surge unlike anything we've seen before. And remember, silver's value doesn't just come from being a precious metal, it plays a vital industrial role, which we'll dive into later. But right now, imagine a world where inflation spirals out of control, central banks scramble to stabilize their economies, and investors pour into silver, driving prices sky high. The question is, how much higher could silver go when paired with another looming disaster? America's crushing debt burden? Because if inflation doesn't get you, debt doomsday might. And silver could be the only safe haven left. Debt doomsday. The moment when the weight of America's $34 trillion debt crushes the global financial system. It's not a matter of if, it's a matter of when. And if Fort Knox gold reserves are missing, that when just got a whole lot closer. Why? Because the US dollar's strength hinges on global trust. Without the gold to back that trust, the dollar becomes just another piece of paper. As the dollar weakens, the cost of servicing America's massive debt would skyrocket. Interest rates would surge as foreign investors flee US treasuries, forcing the government to print more money to cover rising obligations. The result? Hyperinflation and a full-blown debt crisis. Michael Pento has been sounding the alarm for years, warning that the US is sleepwalking into a debt-driven disaster. But here's the kicker. If Fort Knox's gold reserves are revealed to be missing, it wouldn't just accelerate the crisis, it would amplify it. Imagine the panic as the last symbol of dollar credibility evaporates. The government would face two options, both disastrous: default on its obligations or print trillions more dollars, triggering hyperinflation. Either path leads to financial chaos. So, where does silver fit into this apocalyptic scenario? Historically, silver has thrived during debt crises. Why? Because when fiat currencies collapse under the weight of their own debt, hard assets become the last store of value. Silver, being both a monetary metal and an industrial powerhouse, stands to benefit immensely. In past crises, silver didn't just rise, it exploded. And this time, with industrial demand at record highs and physical silver shortages looming, the price surge could be unprecedented. But the story doesn't end there. Silver isn't just poised to surge because of financial panic. There's another powerful force driving silver's value: its critical role in the technologies of the future. Solar panels, electric vehicles, 5G networks. These aren't luxuries. They're the backbone of tomorrow's economy, and silver is at the heart of them all. As we move forward, understanding silver's industrial demand will be key to seeing why its breakout could be bigger than anyone expects.
Well, the most important concept to grasp when managing money, in my humble opinion, is the second derivative of inflation in the context of growth. And I believe the $5 trillion that was printed over a COVID disaster, it's just taking a long, long time to come out of the system. So I'll give you an example of what I'm talking about. So we talked about the reverse repo facility that was at once $2.5 trillion in the summer of 22. It's now down to just a couple of dozen $1 billion. So that's out of the system. But there's still about $700 billion in the Treasury General account. That's liquidity out there. And then I was looking at the reserves in the system, the reserves in the banking system. There's a tremendous amount of reserves out there. It's over $3 trillion in reserves. And you think about well, put that in context, Mr. Pento. What does $3 trillion in reserves look like, historically speaking? Well, if you look at prior to the global financial crisis, there was like nothing. There was like $50 billion of reserves in the system. And now there's over $3 trillion. So you ask yourself, well, what's going on in the economy? What's going on in the markets? Well, what's going on in the economy is that the lower three quintiles of consumers, so the bottom 60%, are decimated. They're wiped out. Inflation has crushed them. That's why defaults and delinquencies are a 5-year high. But then you look at the top two quintiles, especially the top quintile, and they're doing great. They've never been better. Their houses haven't gone down yet, and their real estate portfolio is fantastic, and their stock portfolio is doing great, and that's keeping the economy running, moving just nicely. But as I said, the inflation has wiped out at least the bottom 3 or 4 quintiles. This really, really hurt them the most. So you have all this liquidity out there, which is boosting markets and keeping the top 20% healthy and paddling along very vigorously.
Silver isn't just a safe haven for uncertain times. It's the metal powering the future. While gold sits in vaults, silver works. It's in the solar panels driving the renewable energy revolution, the electric vehicles transforming transportation, and the 5G networks connecting the world. Silver's industrial demand is unlike any other precious metal, and right now it's soaring. The solar industry alone accounts for nearly 20% of global silver consumption, a figure climbing fast as governments worldwide push for net zero carbon emissions. But here's what makes silver truly unique. There's no substitute. High-efficiency photovoltaic cells and solar panels need silver. Without it, solar energy production would stall. And with billions being poured into renewable energy projects globally, the demand for silver is on a trajectory that mining supply simply cannot match. This isn't a temporary trend. It's a structural shift. The future is green, and silver is the metal making it possible. And it's not just solar. Electric vehicles are set to triple in production by 2030, and every single EV relies on silver. From batteries to circuitry, silver's superior conductivity makes it essential. Then there's 5G technology. As the world races to build faster, more reliable networks, silver's role becomes even more critical. The combination of these industries is creating a perfect storm of demand at a time when silver supplies are under immense pressure. Now, imagine adding a global financial meltdown to this scenario. If Fort Knox's gold is missing, inflation and debt panic will drive investors into silver. But they won't be alone. industrial demand will still be surging. This dual demand from both investors and industry could push silver prices into uncharted territory. Historically, silver has been dragged up by gold during crises, but this time, silver has its own rocket fuel. The question isn't just how high silver could go, it's how fast. And yet there's another factor most people aren't talking about, one that could ignite silver's price overnight. While industrial demand and inflation fears build pressure, the physical silver market faces a critical shortage. When that shortage meets panic buying, we could see a silver short squeeze that shocks the world. Let's dive into why this shortage could be the trigger that sends silver soaring beyond anyone's expectations.
So I own an inflation hedged ETF, which has a lot of land in it that produces real assets, not real estate. So you think about gold mines and agricultural commodities, you think about energy, natural gas, oil, then that's a wonderful hedge against inflation. But I want to, if you don't mind me taking a minute talking about gold, there's a lot of reasons why gold should not be at record highs. We're keep bouncing our nose against $3,000 an ounce. And you think about it, well, we're talking about interest rates. Well, interest rates, nominally speaking, have stopped going down. They're now headed higher. The dollar has been extremely strong. Bitcoin, there's an obsessive compulsive nature in the media and even in the administration about Bitcoin. I don't understand it, but that's stealing a lot of gold's thunder. Peace is supposedly breaking out all over the world, right? Ukraine, Russia, Gaza. Well, thank God for that. I hope it's true. You have the Doge boys, or actually it's just now one, in DC supposedly cutting out waste and fraud and abuse. So that's also very positive for our fiscal agenda going forward. So that should be negative to gold. So it just bothers me a lot that gold just can't go down. Have you noticed lately that the dollar goes up, gold goes up, interest rates go up, gold goes up? No matter what happens, peace breaks out in the Middle East and in Russia and Ukraine, and gold goes up. Well, why? Why is that? And I have a theory. I don't know if it's really. I have a theory that something's going on, and I've heard stories about a lot of gold coming into this country from overseas. Here's a theory for you, and it's not mine. I didn't come up with it myself, but I've used my 34 years of experience in this business to analyze it, and I kind of believe it might have some credence. What if, Donegan, the Treasury's 261 million ounces of gold that they say they have isn't really there? And you have a new sheriff in town who's prone to doing a lot of audits of things like the Fed, maybe even the audit of the Treasury. What if they're scrambling? What if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That makes some sense to me. Because there's something else going on. It isn't a recession. It isn't a crashing dollar. It isn't a crashing economy. It isn't a crashing stock market. It isn't plunging real interest rates. What is it? Why is gold where it is? You could explain some of it with inflation, but I think there's something else going on there, and I think what I've just mentioned could be a reason.
The silver market is a ticking time bomb, and hardly anyone sees it coming. While demand for silver surges, driven by both investors seeking a safe haven and industries relying on silver for critical technologies, there's a crisis quietly brewing: a physical silver shortage. Unlike gold, which largely sits in vaults untouched, silver gets consumed. It's used in solar panels, electric vehicles, and electronic devices, often in amounts too small to recycle economically. Once it's used, it's gone. This relentless consumption is draining available supplies at a time when demand is reaching record highs. But here's where things get explosive. For years, large financial institutions have been shorting silver, betting that prices would stay low. This manipulation has kept silver undervalued, suppressing prices below what fundamental demand and supply dynamics would justify. However, when the physical shortage becomes undeniable, those institutions will be forced to cover their short positions. This is what's known as a short squeeze. And when it happens, silver prices don't just rise, they explode. Think back to 1980 when silver shot from under $6 to nearly $50 an ounce in a matter of months, or 2011 when it surged from $9 to almost $50. Both times, price suppression was followed by violent corrections. Now, layer this on top of the potential Fort Knox scandal. If the world discovers that America's gold reserves are missing, panic will set in. The dollar will plunge, inflation will soar, and investors will flood into silver, desperate for a tangible asset. This surge in demand will collide with the physical shortage, forcing short sellers to scramble and cover their positions. The result? A rapid, violent spike in silver prices that could dwarf anything we've seen before. And it's not just theory. The signs are already there. Global silver inventories are falling. Mining output is declining because low silver prices have discouraged new exploration. Refiners can't keep up with industrial demand. It's the perfect storm. Rising demand, shrinking supply, and a looming financial crisis that could trigger the mother of all short squeezes. But there's another angle to this silver story, one that could multiply the gains even further. While physical silver prices skyrocket, silver mining stocks could offer even greater returns. Historically, when silver runs, silver miners soar, sometimes by 500% or more. The question is, with the physical shortage looming and the potential for a short squeeze on the horizon, could silver mining stocks be the ultimate play in this unfolding crisis? Let's explore why silver miners might be the hidden jackpot waiting to be uncovered.
But until then, you hold your bonds, your short-term bonds, and you could hold your inflation hedges, and you can make some money while you wait for what I call the grand reconciliation of asset prices to occur. And why do I say that? Because when you look at things like the Buffett indicator, which is the total market cap of equities to GDP, currently sitting well north of 200%. So when the valuation of equities, the market cap of equities, is over 2 times the level of annual GDP, which is extremely rare. This is a new phenomenon, Dunning. It never happened before in history. Prior to COVID, it just was never even thought of. The normal metric here, the normal ratio, is south of 1. It's over 2. Stocks have to correct dramatically. Real estate has to correct dramatically. And also bonds. And I'm talking about corporate debt. There's a huge bubble in corporate debt. That has to correct. If you think like things like private credit, something that never existed before. This is a new invention by Wall Street. Hey, the shadow banking system is saying you're a business, you can't get a loan from a bank, and you can't tap the corporate bond market. Well, come to us and we'll give you a loan. And there's $1.5 trillion of that stuff out there. Now, when we have a recession and people are going to call up their friendly financial institution and say, that money I gave you for that private credit loan, I want it back. Well, we don't know what that market is, and you can't get it back. That's a real problem.
When silver rallies, silver miners don't just follow, they skyrocket. Historically, silver mining stocks have acted like a leveraged bet on silver itself. In previous bull markets, silver prices may have climbed 400%, but miners? They've delivered gains of 500% or more. Why? Because mining companies benefit exponentially as silver prices rise. Their operational costs remain relatively stable, but every dollar increase in silver prices drops straight to the bottom line, dramatically boosting profits and, in turn, stock valuations. Now picture this. The world wakes up to the realization that Fort Knox's gold reserves are missing. The dollar collapses, inflation rips through the economy, and silver prices surge. In such a scenario, physical silver becomes scarce and prices soar. But investors looking for even bigger returns turn to silver miners. The reason is simple. Miners can multiply silver's gains. With the physical silver market constrained by supply issues, miners become the primary source of new silver. As silver prices climb, miners' profit margins explode, attracting a flood of investor capital. And there's more. Many silver mining companies have been severely undervalued for years due to prolonged price suppression in the silver market. This means they're starting from a low base, offering massive upside potential. As silver breaks out of its suppressed trading range, these stocks could see rapid revaluations. Historically, this pattern has repeated time and again. In the late 1970s, silver bull market mining stocks like Hecla Mining and Core Mining posted gains of over 1,000%. In 2011, similar patterns emerged, with silver miners outperforming the physical metal by a wide margin. But this time, the setup is even stronger. With silver's industrial demand booming, physical shortages looming, and the potential for a Fort Knox-triggered panic, silver miners could be positioned for their biggest run yet. The combination of rising silver prices and constrained supply means miners with proven reserves could become gold mines, pun intended. The window of opportunity, however, is closing fast. Once silver prices break key resistance levels, miners will no longer be cheap. The smart money is already accumulating these stocks, quietly positioning for the next breakout. But the timing is everything. Investors who get in too late could miss the majority of the upside. So why is now the moment to watch silver miners closely? Because all the factors we've discussed, dollar weakness, inflation, physical shortages, and suppressed silver prices, are converging right now. And when they do, silver mining stocks could deliver life-changing gains. But before we tie all these threads together, we need to answer one critical question. Why now? Why is this moment different from every silver rally that came before? Let's explore why all signs point to an imminent silver supercycle.
So, and core PCE and super core, you can measure it 6 ways to Sunday. I don't care. Listen, the level of prices has already bankrupted the bottom 3 quintiles of Americans. So it's not that people are saying, oh, I'm so grateful, Mr. Powell, that inflation came down from 9% on a rate of change basis to 3.5%. No, it's rising further and faster away from a level that allows me to support my family, to buy groceries, to own a home, to pay for insurance, to pay taxes. So that's the real issue. So if you have inflation that's running, quasi-intractable, and the Fed has and here's the punchline, Dan again, the Fed has a bias to ease, which I think is hysterical. I think that's hysterical. They have a bias towards easing. They were easing. They cut rates already by 100 basis points, but they still have this easing bias. Well, why do they have an easing bias when inflation is 4 years north of their target, their average target? You get the point. I don't want to belabor it, but when you have insolvency and you have inflation, that's what the long end of the bond market is always concerned with. And that's why yields are rising. And that's why your cost of your home, which is already as a home price to income ratio is at a record high. And when you throw in maintenance and insurance and taxes, it's out of reach. And then you say, well, wait, now the mortgage rates are going higher. They're up 100 basis points since the Fed decided it was a good time to panic in September of 2024 and cut rates by 50 basis points. That's your answer. So that's where your real problem could be. Now, I'm not saying it's definitely going to happen, and I'm not saying when it's going to happen, but you have those 2 real risks of when you're going to have a freezing up of the money markets. And that could cause,
Timing is everything. And right now, all the signals are flashing that silver's moment is finally here. For decades, silver has lagged behind gold, waiting for the right mix of market forces to ignite a supercycle. But this time, the stars are aligning like never before. Inflation is creeping higher, debt levels are unsustainable, industrial demand is booming, and physical silver shortages are tightening the market. Add in the looming possibility that Fort Knox's gold reserves might not exist, and you have a perfect recipe for a silver breakout that could be historic. But let's get specific. One of the clearest signals that silver is about to surge is the gold to silver ratio. This ratio tells investors how many ounces of silver it takes to buy 1 ounce of gold. Historically, when this ratio reaches extreme levels, like it is right now, silver doesn't just catch up, it explodes past expectations. In 1980, when the ratio collapsed from 80.1 to 16.1, silver's price soared nearly 800%. In 2011, a similar correction sent silver surging by over 400%. Today, the ratio is once again at historically high levels, suggesting silver is massively undervalued and poised for a violent reversion to the mean. But there's more. Central banks around the world are stockpiling gold at record levels, signaling a growing lack of faith in fiat currencies. Yet silver remains under the radar, still trading far below its previous highs. Historically, silver lags gold in the early stages of a precious metals rally, only to surge dramatically when investors realize the opportunity. With physical shortages looming and industrial demand surging, silver's catch-up phase could be explosive. And the Fort Knox controversy could be the spark that lights the fuse. If the gold supposedly backing the US dollar is revealed to be missing, it would send shockwaves through global markets. The dollar's credibility would collapse, inflation would skyrocket, and investors would panic buy hard assets. Silver, with its dual role as both a monetary and industrial metal, would become the asset of choice. Investors who wait for the headlines will be too late. History shows that once silver starts to run, the rally happens fast and without warning. But there's another reason why timing is critical right now. Silver is approaching key technical resistance levels. If it breaks through $35 an ounce, momentum could push it to $50 and beyond at lightning speed. And given the supply constraints and industrial demand pressures we've discussed, this breakout could happen sooner than most expect. The question investors need to ask themselves is simple. Do they want to be positioned before the breakout, or will they chase the rally after the fact? All signs point to now being the moment. But what does it all mean? Silver's industrial demand, looming supply shortages, a potential short squeeze, and the possibility of a Fort Knox-triggered panic are all converging. So, what's the final verdict? Let's wrap this up with Michael Pento's ultimate warning and explore why silver's coming breakout might not just be another rally, but a historic wealth transfer event. This is it, the moment everything comes together. Michael Pento's warning is clear and simple. If the gold reserves at Fort Knox have vanished, the global financial system will face a reckoning like never before. The dollar's credibility would collapse overnight, triggering an inflation tsunami and a debt crisis that could sweep across the world. In that scenario, gold prices would soar. But silver? Silver could break free in a rally so fierce, it would rewrite the rules of the precious metals market. Why silver? Because silver isn't just gold's little brother. It's the metal that investors turn to when gold becomes too expensive, the metal industries rely on for the future, and the metal that has historically delivered the biggest returns when panic grips the market. Silver's dual role, both a monetary asset and an industrial powerhouse, gives it an explosive edge. The gold-to-silver ratio is screaming that silver is undervalued, industrial demand is surging, and physical shortages are looming. Add the threat of a short squeeze, and you have the perfect storm for a silver supercycle. This isn't just speculation, it's the logical outcome of a system built on trust. Trust that could vanish the moment Fort Knox's doors are forced open. The window to act is closing fast. When silver starts its breakout, it won't wait for anyone. The speed and scale of the surge could be unlike anything we've seen before. The question is, will you be positioned before the headlines break, or will you be chasing the rally when it's already too late? If you see what's coming, don't wait. The biggest financial shift of our generation could be underway, and silver might be the key to navigating it. But remember, this isn't financial advice. Always speak to a licensed professional before making any investment decisions.